Welcome to the show. I'm Michael Johnston. Joining me today to talk about tax efficient investing is Alvin Carlos. Alvin is a managing partner at District Capital, a financial planning firm in the DC area, helping professionals in their 30s and 40s. Alvin, welcome to the show.
Thanks, Michael. Happy to be here.
So I'm excited to talk about UTMAs, UGMAs today. This is something I got the idea for this because I was talking with a friend who had screwed this up and didn't understand what these were. Not super complicated, but there can be some ways to go wrong here. So we're going to set them straight. We're going to provide some good information here from Alvin. He knows a ton about this. Alvin, let's dive right in here. So we're talking about custodial accounts. So at a high level, what is a custodial account? How does this work?
Custodial accounts are taxable investments that is set up and controlled by an adult in the behalf of a minor. So the typical example is a parent or a grandparent opening a custodial account for their child.
Got it. So it doesn't have to be just a parent, or it doesn't have to be a grandparent. It can be anyone essentially can contribute to one or can set one up. Is that right?
Exactly. It can be anyone. It can be Taylor Swift opening up a custodial account for one of her fans. It can be anyone. Yeah.
Okay. I love that example. So a couple of the ones that we're talking about today, we've got UTMAs and UGMAs, which is a mouthful. So a lot of similarities here, a couple of differences. What are the run down these for us? What are the similarities and differences between these two types of accounts?
UTMA stands for the Uniform Transfer to Minors Act, and UGMA stands for Uniform Gifts to Minors Act. They're essentially laws that allow gifts, either cash or stocks or bonds, to be given to minors without tax implications. And so the main difference is what type of accounts can the adult, in this case, typical case, a parent can give to their child. A UGMA can only contain financial products like stocks or bonds, ETFs, mutual funds. A UTMA is more inclusive, so you can give financial products there, or you can also do physical assets like jewelry or real estate.
Got it. So a little bit more flexibility in terms of what you can include in there.
Exactly.
So what are the advantages here? Why is this a good idea? Who might want to think about setting up a UTMA or a UGMA for a minor? What's the use case? Why is this potentially a smart idea?
These are often used by parents who want their kids and who want to give their kids a financial head start. So for example, if you are planning to eventually leave some of your money to your kids, and because you're a high net worth individual, you're probably going to pay estate taxes down the road at the state level. It's higher at the federal level, but some states, we can talk a little bit more about this, but some states you end up paying a ton of estate taxes. So this is also for high net worth individuals who want to leave a legacy to their kids. And the reason is you can give the power of compounding to your child early on. Everybody knows the power of compounding. If you start at an early age, you invest it in stocks, it can grow like triple, quadruple, etc. And the nice thing about this compared to other types of accounts is you can use it for whatever purpose, and there are no contribution limits. There are no income limits. It doesn't matter how much you make, and you can give as much as you want each year. Obviously, you have to keep in mind that at least for 2023, you can give as much as $17,000 without having to file a gift tax form.
Got it. Yeah, so let's talk about that gift tax piece of this a little bit. You mentioned for folks who are potentially going to run up against the estate tax. There's a limit, there's a federal limit, and then there's often state limits of how much you can transfer to future generations before you have to pay. The way that it works in this country, our tax code is essentially, in most cases, I'm simplifying a little bit here, but you pay taxes when you gift someone money if you go over this threshold. And I think the threshold, Alvin, you probably know better. It's about $12 million right now. Exactly. I think it's going to go down in a couple of years if Congress doesn't act. So how does this kind of piece together with that for folks who are going to run up against that? You mentioned that you can transfer $17,000 without starting to use up your exemption. So let's dive in a little bit deeper to that. How does that? How does all that work for folks who are potentially going to hit that $12 million mark?
So essentially, if you expect to hit that estate tax exemption for federal government and also for states. So for example, some states can impose as much as 16% or 20% of any value above a certain amount, and you pay estate taxes. Using the UTMA or UGMA can help you avoid paying that hefty estate tax piece down the road, because you can keep on giving $17,000 a year, and it usually increases every year.
Yep.
If a couple, you can give twice that amount, $34,000 a year to your child, and basically avoid paying several thousands of dollars in taxes, federal and state taxes down the road if you use these UTMA accounts.
Yeah. And I think for a lot of folks, don't have to worry about hitting that federal estate tax limit. But you just mentioned, I want to go back to this, but it's a great point. I think it gets lost a lot. You have to think about the state tax level as well. So I live in Oregon. I think we might have the lowest. I think it's $1 million for Oregon.
That's right.
So it's still a decent hurdle, but all of a sudden for folks thinking, oh well, I'm not going to have to worry about transferring $12 million. $1 million is a much lower threshold. So if you're going to be eventually transferring that much, this is kind of a way around it. You can give $17,000 individually, $34,000 as a married couple. As Alvin just mentioned, those numbers typically go up each year. Those are the 2023 numbers. So if you're listening or watching this in a future year, it may be higher. So you're essentially able to transfer to future generations. I keep saying to future generations. The most common use case is to your kid, but as Alvin pointed out, it could be anyone who you're transferring it to, any minor who you're transferring it to. And it's a way to transfer money without it contributing to that lifetime exemption at the federal or the state level.
That's right.
So let's talk through. My wife and I, we say, hey, we might leave our children more than $1 million. We live in Oregon, which has a very low threshold where we don't want to pay a lot of estate taxes. We should set up a UTMA. I'll just use the UTMA example for now instead of UGMA. We want to set one up for our son so that we can transfer him some money and save on estate taxes down the road. Walk us through the process. What does it look like? How complicated is it? How do most folks do it?
The easiest way is to set up these UTMA accounts in your favorite brokerage account. So I typically have my clients set up in a Vanguard or a Fidelity account.
Yep.
You can also do this with Schwab and other famous or popular brokerage accounts. And they will usually have a section in there that says education or for children or custodial account. So that's where the UTMA account is going to be at. And essentially, you just need to provide your contact information as the adult who will control this account, and name, date of birth, social security number of the minor, child or your grandchild or whoever. And it's pretty straightforward. After you set that up, and you can just leave it there with put $100 if you want, and it's pretty straightforward.
Yeah. Okay. Great. So you mentioned Alvin that this is a taxable account, which is important to note here. But there's a couple of relatively minor tax benefits. Not as substantial as some of the other incentives in the tax code, but there are a couple of tax benefits here that you can end up paying a little bit less in taxes. Can you talk through some of the potential savings there?
Yeah. So if you have unearned income is going to be the term that would be applicable to this, because if your child works at a grocery store, then they will get earned income, which is they actually worked and exchanged labor for it. If you have money in a UTMA account for your son or daughter, and it's going to most likely earn dividends if you invest it in stocks or bonds, and that's considered as unearned income. And any unearned income up to $1,250, $1,250 is not taxed. That's in 2023. And so if you put in $20,000 in your child's UTM account and you invest it, let's say, in a bond ETF that makes 5%, you get $1,000 a year in dividends. That's below the threshold, and you don't have to worry about paying taxes on that. So that's one of the nice benefits of a UTMA account.
Yeah. And we're not talking huge dollars here. I mean, I guess it's all relative, but it definitely can lower your taxes. And instead of having to pay it instead of the parents having that income, that unearned income, as Alvin mentioned, that's kind of a key term. It gets transferred essentially to the minor, and if they're under the threshold, there's no taxes. So it's essentially a tax arbitrage strategy here. Unfortunately, that threshold is pretty low, $1,250. I think the next $1,250 gets taxed typically at the kiddie rate, which is 10%. So another little tax arbitrage there, moving down from a slightly higher bracket down to 10%. I think ultimately we're talking about a few $100s, probably under $1,000 a year in tax savings, but tax savings nevertheless. And then I think I want to kind of emphasize one point here. Alvin mentioned that this is unearned income, and that's an important distinction. Alvin, I was talking recently, we just did an episode, I'll put it in the show notes, about the child IRA for parents who set up a Roth IRA for their kids. Again, like the UTMA, it's pretty easy to set up. The harder part is getting your kid earned income so that they can actually contribute to it. So unfortunately, this won't help you with that, because this is unearned income. They've got to, in order to be eligible to contribute it to a Roth IRA for your kid, they've got to actually be doing work, whether it's bagging groceries or summer job as a lifeguard, or there's some other creative ways to get money for that. But unfortunately, this won't work. This won't work for that. So Alvin, you talked about this has some more flexibility than some other accounts. It can be used for anything. I think you were probably alluding there to a 529, which is another option where parents can fund a 529 or grandparents can fund a 529. But then that has to be used for education expenses. Is that right?
That's correct. So if you're planning on helping out your son or daughter pay for college expenses, which, as we know, is astronomical these days. And typically you want to look at a 529 because in a UTMA account, you end up paying taxes after you've achieved a certain amount of unearned income.
Right.
But in a 529, you don't pay federal and state taxes on all of your earnings, regardless of how much those earnings are. And in addition, for some states, if you live in a particular state, so I live in the Washington, D.C. area, D.C., Maryland, Virginia residents, if you contribute to a 529 up to a certain amount, you can deduct those contributions from your state taxes. So that's also a nice tax advantage with a 529. Yeah.
So I think in summary there, if you're thinking about, well, how do I save for this astronomical cost of college? I think in general, 529 is going to be better. As Alvin kind of ran through there, you get tax-free growth. If you use it for qualified education expenses, you're going to get tax-free withdrawals as well to fund those education expenses. Potentially a deduction on your state income tax. That varies by state. I think Oregon is a little bit less generous. There's a relatively small, I think they cap it at a pretty low amount, but still I contribute to a 529 and I'm able to reduce my state taxes a little bit, a ton of variation there on those incentives. So if you go with the 529, you generally get more tax benefits. It is more rigid, as Alvin mentioned. You've got to use it for qualified education expenses. A UTMA can be used for anything. So like a lot of tax incentives, you give up a little bit of flexibility in exchange for realizing them. Alvin, I always like to ask this: what are mistakes that you see people make with UTMAs or with custodial accounts in general?
Some parents jump into the idea immediately without thinking through the implications. So what I mean by that is once you contribute money in your UTM account, there's no takebacks. There's no takebacks. So if, for example, if your household faces financial hardship, let's say both spouses are high income earners, but one spouse, for example, loses his or her job, you can't tap into that UTM account for emergencies. Or, for example, you started it where your son or daughter are still young before they're teenagers, and as they're growing up, you're like, oh, looks like my daughter is not as mature as I'd hope. I want to be able to limit her ability to buy, I don't know, a motorcycle once she turns 18 or 21, because basically once your child becomes the age of majority, they can do whatever they want with that money. And so there are no takebacks. So you have to be ready for that. And so you have to think through exactly, I guess, what your parenting philosophy would be before you open a UTMA account.
Great points there. Alvin wrote a great article on UTMAs. We'll be sure to link to that in the show notes. Another point you made, kind of on the flip side of that, is another potential benefit here outside the dollars and cents is these can be a great way to teach your kids about money, to teach financial literacy. I think, we don't often appreciate that, and there's definitely a need for that in this country. So I thought that was a great point that you made there. Alvin, a good way for kids to feel ownership, understand that this money will be theirs someday, get them excited to, I don't know, maybe check the stock market or...
Thank you. This might reveal my age a little bit, but when I was young, my parents opened just a regular savings account for me when I was young. And this was back in the day where we would get a passbook. It's a physical
thing. I remember those.
Like a passport. And then you go to a bank and then they would, put some electronic writing on it that says, oh, you earned $2. And I was so excited every time I saw it, I would just keep my passbook there as if it was a treasure chest on it in itself. And if you go through the process of opening a UTMA with your child and show them, okay, we invested it in this mutual fund, and look, it just made $3 for us this month. And you can then explain, where does that come from? So you can talk a whole bunch of things and give your child financial literacy early on.
Yeah, I love that. I hadn't thought about that passport or that passbook in a long time, and I'm flashing back here to my childhood. State Savings. I still remember the name of the bank, State Savings Bank. I'm sure long since gobbled up by someone else, but they had the exact same thing, and it was always going to the bank was always very exciting because you got an update on that, and you usually got a lollipop too. There was a whole jar of them.
That's where they get
by the door. But it's a great point. It's a great way to teach kids about financial literacy, to understand the power of compounding returns. Maybe that's a bit more sophisticated at a younger age. They're just thinking about baseball cards or whatever kids buy nowadays, Pokemon cards that they can buy with it. But great way to kind of impart some of that wisdom. There's just a couple other questions here, a couple other wrinkles in the UTMA. Alvin, I understand there's a couple states, I think it's Vermont and South Carolina, they don't allow the UTMA, I believe it is. Is that right?
That's right. So almost all of the states except Vermont and South Carolina has passed these UTMA laws. So, but it's fine. Usually most parents will just prefer to invest stocks and bonds with it. So with a UGMA account, you can still do that.
Yeah, you're fine too. So the UGMA is the one that has a little less flexibility. You've got to use kind of the plain vanilla financial instruments. You can't invest in the more exotic or alternative assets. But as Alvin mentioned, for 99% of people, that's going to be totally fine. So if you live in Vermont or South Carolina, fear not. And then how should parents think about financial aid if they're contributing to a UTMA? How is that viewed when it comes time to apply to colleges and colleges are looking at the financial ability of the family?
That's where one of the downsides will come in again, Michael. So typically, if you have a 529, when the time comes where you need to fill up what's called a FAFSA, financial aid form, they will count, for example, if you had $10,000 in your UTM account, they will count 20% of that, and your eligibility for aid will be reduced by that amount. Whereas if you had the same amount in a 529, they will only count 5.64% of that amount if you had that amount in a 529. So UTMAs have a little bit of a disadvantage on that when it comes to financial aid purposes.
Yeah, got it. So I think in general here, at least how I would view these is not probably for a lot of folks the best way to save for college. Can be a good way if you're going to be running up against either the federal or your state's lifetime estate tax exemption. Can be a good way to think about transferring money to future generations. And as we talked about, a little bit of a cherry on top, a little bit of tax savings, probably ends up being at most a couple $100 a year for most people. But hey, every little bit helps, right?
That's right.
Well, Alvin, my last question for you: where can folks go if they want to find out more about you and your firm?
They can check out our website. Just go to districtcapitalmanagement.com. For those who are more visual people, we have a YouTube channel. So if you go to YouTube, just type in District Capital. We have a bunch of videos, beginners, intermediate, advanced level, where they can all learn from that.
Yeah, great. And it's a great YouTube channel. It's got a lot of really good information on there. Alvin and his team do kind of a great job of simplifying a lot of these topics, like you did for us today. So we'll put a link to both the website and the YouTube channel in the show notes. Alvin, I want to thank you for coming on. This was really informative. You've been a great guest.
Thank you so much, Michael.